you are likely missing three of the most powerful signals in modern market history. First, we're going to talk about a setup that's produced some of the strongest returns we've ever seen, and it's playing out right now. Then, why unified control of government has been consistently positive for markets in a way nobody talks about. And finally, we'll talk about the most obvious pattern everyone watches that's completely wrong. So make sure you watch all three parts. Welcome to the Dean's List, everyone. I'm Dean Lolkin, investing veteran and private credit CEO here to help you grow your wealth. Right now, everyone's focused on the wrong things for 2025. Cabinet picks, legislative changes, wars raging abroad. There is no shortage of reasons for widespread anxiety. First pattern is already setting up and almost no one is talking about it. Let me show you the most reliable pattern in modern market history. It's a specific one that doesn't happen often, but when it does, the returns have been extraordinary. Here's what makes this setup special. You get two strong years in the S&P 500 leading into the first year of a president's second term. That's where we are today. It's the combination that matters. You've got market momentum. You've got an administration businesses understand, and you've got something even more powerful, a focus on execution rather than disruption. Let's look at Reagan's second term, 1985. That's the first year of his second term. The S&P 500 had momentum with two positive years coming in. Businesses had adapted to the administration's approach. Policy was predictable. The result, explosive 31% gain in the S&P 500. Then Clinton's second term. The first year was 1997. Strong market momentum from previous years, a tech boom accelerating, and clear policy direction. What happened? Another massive year, plus 31%. And our third example is Obama's second term in 2013. The same pattern repeats. Two positive years leading in. Businesses had fully adapted to the Obama administration, and so markets turned their focus to stability. Once again, a positive 32%. 3 different decades, 3 different economic environments, 1 consistent result. Returns over 30%. So what about the fact all these examples featured a divided government? It's an interesting little tidbit. Well, in 2025, we're going to have to worry about a unified control of Congress and the White House, right? So maybe things will be different, or maybe they won't. Here's what everyone misses when the president's party controls the House and Senate at the same time. It's actually been consistently positive for markets in both first and second terms. Now let's look at every modern case of unified control. First, we'll look at first term, first years. Clinton, 93, plus 7%. Obama, 09, plus 26%. Trump, 2017, plus 22%. Average return of 18%. Second term first years, we just have one example to look at, and that's G.W. Bush. In 2005, the market was up about 5%. Still not terrible. So listen closely to the data. Every single case of unified government control, whether first term or second term, produced positive returns. What about Trump? Well, I expect his unusual second term to play out like something in between a first and a second for stocks, after 4 years away from 1600 Pennsylvania Avenue. Why have markets handled unified control of our government by one political party so well over the past 30 years? First, because most policy changes are telegraphed well ahead of time. Markets hate surprises more than they worry over the winners and losers from any particular policy, right? Always think back to loss aversion. Losers hate losing more than winners like winning. Second, American businesses are incredibly adaptable. They find ways to profit in any environment. And third, unified control actually reduces uncertainty. Markets know what's coming and price it in advance. So which brings us to the biggest myth of all. Want to know the most expensive myth in market history? It costs investors billions in missed returns, and almost everyone still believes it. Do you believe the president's party determines market returns? People spend countless hours debating which party is better for stocks. They pull their money out when their party loses, and they get defensive when the other side wins. It's all based on a difference so small, it'll make you cringe. Since World War II, Democratic presidents have averaged about a 10.7% S&P 500 return, while Republican ones got you 9.8% on average. It's a tiny difference. So why? Because what really drives markets has nothing to do with parties. First, markets focus on corporate earnings. Companies adapt and grow regardless of who's in office. They find ways to make money in any environment. Second is innovation. Technological progress and productivity gains happen at the business level. This isn't up to Washington. And third, consumer spending. Americans buying habits and economic activity drive profits far more than any legislation or policy. We can also think about business investment, right? Companies make long-term decisions based on market opportunities and competitive dynamics. The reality? Markets rise and fall based on fundamentals, not party platforms. Look, here's what history is really teaching us about 2025. The perfect setup pattern we're seeing right now, 2 positive years in the S&P 500 leading into a second term with unified government control, has produced some of the strongest returns in market history. Unified control isn't something to fear. It's produced positive returns in every modern case, both in first terms and second terms. And obsessing over which party controls the White House? That's costing you money. Here's the most important point. While these patterns are fascinating, they're not guarantees. The real lesson is staying invested through political transitions has consistently beaten trying to time the market based on politics. Remember, the market doesn't care about your political views. It cares about earnings, innovation, and growth. Those fundamental drivers march forward regardless of who's in office. If you found this analysis helpful, and I hope you did, make sure you follow for more insights like this. We're doing deep dives into market patterns that nobody else is talking about. Smash that like button if you learned something new, and drop a comment below with what patterns you want me to analyze next. I'm Dean Lolkin, and I'll see you on the next one.